In the previous video, we looked at the shooting star. We studied the shooting star. Now we will look at the bearish engulfing pattern. The bearish engulfing pattern is just a reverse of the bullish engulfing pattern. Sorry. The bearish engulfing pattern is just a reverse of the bullish engulfing pattern. It's a two candle bearish pattern. It's a reverse of a bullish engulfing pattern, must come after an uptrend. So in the bullish engulfing pattern, we saw that it must come after a downtrend. This is coming after an uptrend. The high of the pattern becomes resistance. So the highest high of these two candles, whichever is high, that becomes our resistance point. Okay. First candle is a white real body. The first candle is a white real body. The second candle is a long black real body which is completely engulfing the prior white real body. Then the first candle must be as small as possible. So this first candle should be as small as possible and the second candle should be as large as possible. So all the concepts that we learnt in the bullish engulfing pattern, just reverse it and apply it to the bearish engulfing pattern. The shadows do not matter. What matters is the black candle completely engulfing the prior white candle. The white candle should be as small as possible. The black candle should be as large as possible. Psychologically, what this indicates is that the market is going up, the bulls are happy, and suddenly you have a small white candle which confuses the bulls. They are in doubt now. They feel that the price is not likely to keep going up further. So they are nervous. And suddenly this is the final nail in the coffin where the bears stamped their authority and they say that enough is enough. We are taking the price down. So that's the battle between the bulls and the bears which we see in the bearish engulfing pattern. This is even more powerful than the shooting star. So remember, shadows are not a concern and it must come after an uptrend. Okay. So let's quickly have a look at an example. This is very simple. So you have the daily chart of British pound INR. We see that the bearish engulfing pattern becomes our resistance. Just as the shooting star became our resistance, the bearish engulfing pattern, highest high of the pattern, becomes resistance. So I have drawn a purple dotted line here. That purple dotted line should become resistance. Now, ideally I wouldn't take a trade here because there is a gap. I will talk about gaps later because that gap becomes a support area because it's a rising window. In Japanese candlesticks terminology, they call it a window because it's a price vacuum. But that's not the point here. The point here is the bearish engulfing pattern becomes resistance, and as you can see here, see this resistance, it's a daily chart. So this resistance has held for quite a few days. These two candles have, this is a shooting star, this is a shooting star. These two candles have tried to break that resistance, but forget about breaking or closing above the resistance. They have not even crossed the resistance. So that's the power of the bearish engulfing pattern. Another thing to remember is I told you that the reversal pattern, any reversal pattern, all of these patterns that we are studying are reversal patterns. So any reversal pattern does not say that the market will go from up to down or from down to up. The reversal pattern is just indicating that the prior trend is likely to end. What's the prior trend here? The prior trend is up. So it ends with the bearish engulfing pattern, meaning that the price is either going to go flat or it is going to go down. In this case, it has chosen to go flat because there is a window here. That we will discuss later, but please understand that the bearish engulfing pattern becomes a very strong resistance that gives us the confidence to keep our stop loss above this resistance line. Another quick tip for you is the 5-session rule. This I learned from my coach Steve Nissen. If you don't get the desired result, then exit the trade. So in 5 sessions, so after I take a trade here, for example, I wait for 5 candles. So 1, 2, 3, 4 and 5. Up until this candle, if I don't get my desired result, I should be out of the trade. The reason for that is if I'm not out of this trade, my money is still stuck in the market, because essentially here the market is flat. So the 5 session rule tells us exit here and use the money to take some other trade. Otherwise your money will get stuck here. So in this case, our money would have been stuck for so many days, more than 1.5 weeks. In this case, it's a daily chart. So that's why the 5 session rule works. You take the trade, you wait for 5 sessions. If the market doesn't go in your direction, it's probably a good idea to exit the trade. It is not going your way. Okay.